ETFs are one of those things people online mention a lot, usually with confidence and not always with a clear explanation of what they mean. So let's fix that. Hello and welcome to Acting on Finance. I'm your host David, a man who seems to have come out of COVID with fewer social skills than he went in with. Now before we get into it, quick note, this is for education, not financial advice. Although if I was giving advice, it would be to adopt a structured approach to small talk. I personally stick to the 3 T's, traffic, temperature, and trains. Because between them, there's always just enough material to sustain something that technically qualifies as a conversation, which, fun fact, is incidentally also the core writing rule behind Neighbours and Home and Away. Let's talk about ETFs. Most people hear the term ETF and immediately decide that sounds like something they should already understand but don't, and now it's too late to ask. What are ETFs? An ETF is an exchange-traded fund. It's just a collection of investments bundled together that you can buy in a single trade. Instead of picking one company, like buying shares in Apple or BHP, you're buying a slice of multiple companies at once, sometimes hundreds, sometimes thousands. Which means instead of relying on one thing to go well, you're relying on a lot of things going reasonably well, which is significantly less stressful and more diversified. The easiest way to think about ETFs is this. Buying individual shares is like buying a single movie. Buying an ETF is like buying a franchise. Suddenly you're not relying on one film to do well, you've got a whole slate of them. Some will be hits, some will be disappointments, but overall if they perform reasonably well, you still take money. How are ETFs built? Now where ETFs get interesting is how they're built. Because not all ETFs are the same. Some are actively managed, where someone's trying to pick the right investments for you. Some focus on very specific sectors like technology, or themes like socially responsible, or strategies like companies that provide dividends. But when people online talk about ETFs, what they're usually referring to is an index ETF, which means they're designed to follow something called an index, which is just a list of companies grouped together based on a set of rules. For example, the ASX 200 is the 200 largest companies in Australia, and the S&P 500 is the 500 largest companies in the US. And instead of trying to pick winners and losers from those lists, index ETFs just buy all of them in the same proportions and adjust as the index changes. So they're not trying to beat the market, they're just trying to be the market, which sounds lazy but is very much the point. Because trying to consistently outperform the market is extremely difficult, like convincing people the Matrix Resurrections needed to exist difficult. So instead of trying to outsmart the system, index ETFs take a slightly different approach. They do very little, and that approach over time has worked surprisingly well, which is deeply unsatisfying because it lacks the drama. There's no cash raining down, no genius move, no supercuts of someone shirtless on a yacht talking about conceptual wealth while Bitcoin and passive income drift past in a slightly aggressive font. It's more like planting something and waiting as it grows, which is not how the internet has trained us to think about making money. It's the equivalent of watching paint dry, or Brad Pitt in Astra. Let's talk about why people actually use them. There are 3 main reasons. 1, diversification. This just means spreading your risk instead of putting all your money into one company. You spread it across many. So if one underperforms, it doesn't take everything down with it. It lets you build diversification far more easily and with much less money, because to get the same level of diversification through shares, you would need to buy dozens of individual shares yourself, and that doesn't really work unless you have a considerable amount of money. 2, cost. ETFs are generally low cost because they're not trying to pick active winners. There's less management involved, which means lower fees, and fees matter because over time they compound. Number 3, accessibility. You can buy ETFs like shares through a brokerage account, no complicated setup, no minimum millions required, just click and you're in, which is a part of why they've become so popular. Now let's talk about the risks, because despite how they've often spoken about online with glowing reviews, ETFs are not magic beans. There are 3 main risks. 1, market risk. If ever a market fails, your ETF usually falls with it. Owning hundreds of companies can reduce the risk of one business collapsing. It does not protect you from recessions, rate rises, panic selling, or investors collectively losing their minds for a quarter. If the market drops, your ETF usually joins in. Number 2, concentration risk. Remember how I said ETFs mirror the index and buy proportionally? Say you own an ETF invested in the top 10 movie franchises of all time. You've got James Bond, Marvel, Harry Potter, Star Wars, basically everything I spend hours talking to Google AI about. Together they've made roughly $110 billion at the global box office, which sounds like a pretty profitable ETF until you realize the Marvel Cinematic Universe alone counts for around $31 billion worth of that, roughly 28%, from just one franchise. That's concentration risk, when a small number of holdings make up an outsized share of the portfolio and can heavily influence returns. So if one major holding starts underperforming, it can drag the whole portfolio down faster than you can say quantum mania. So yes, you may own a lot, but don't let that lull you into a false sense of security. And number 3, human risk. This is usually the biggest one. And this is where people tend to overcomplicate things. They start adding layers, trying to optimize, timing the market, switching strategies, reacting to headlines, which usually leads to worse outcomes, not better ones. Did you know, over the last couple of decades, missing just the 10 best days in the S&P 500 could cut your total return by more than 50%. 10 days, 2 decades, 50%. That's true. Which is one of those facts that doesn't sit quite right, like the realization that The Rock's name is just Dwayne. Dwayne. So how do you know if an ETF is actually right for you? There are a few things worth checking. 1. What does it actually invest in? Because ETF tells you the structure, not the contents. The easiest place to look is the provider's website or fact sheet. They'll usually show the top holdings, sectors, regions, and what index it tracks. So before buying anything, check what's inside. Number 2, fees. Look for the management fee or the MER expense ratio. That's the annual percentage charged to run the fund. For example, 0.1% is very different to 1% over 30 years. Lower fees aren't everything, but for similar products, they matter a lot. Number 3, diversification. How spread out is it, really? Is it diversified, or does it hold 15 companies that include Apple, Meta, and Netflix, resulting in the diversification equivalent of a Kevin Hart comedy performance? Number 4, risk level. How risky are the assets it holds? A broad share market ETF is generally less risky than a concentrated tech ETF. Ask yourself, could I handle the ups and downs of this specific ETF and still stay invested? Number 5, does it match your goal? Long-term growth, income, stability, retirement? Because buying random ETFs with no purpose is less investing and more Pokemon. So in summary, ETFs can be low cost, simple, diversified, and accessible, but they still carry risks: market risk, concentration risk, and human risk. So if you found this helpful, feel free to like, subscribe, and check out my other videos on investing and super for more breakdowns. And let me know your thoughts in the comments. Or if you want to see me try and explain strategic asset allocation via an in-depth analysis of why Nicolas Cage is both the greatest and the worst actor of all time, with the level of sarcasm that sounds like someone saying "take your time" means they're absolutely judging you, let me know. Or any other names that don't quite fit the actor. Benedict Cumberbatch. Benedict. Also Cumberpatch, which feels unnecessary, like a hat on a hat.